The recent signal that Fed Reserve Chairman Bernanke gave to markets may not mean any dramatic increase in interest rates in the US or globally anytime soon. That's according to David Zahn, who's head of European fixed income at Franklin Templeton Investments. He joins us now from London to discuss where he sees the opportunities and why fixed income is far from dead. And let Warren pick it up.
Great. Thanks for joining us this evening, David. And I'm very glad you penned this letter because we were beginning to think that fixed income was dead. I just wanted to get your sense, especially we've seen Bernanke talk about the tapering in quantitative easing in Europe. And we wanted to see what your perspective was of what was happening. Sorry, Bernanke is going to be tapering the quantitative easing in the US, not Europe. We wanted to get a sense of what was happening in Europe, if a tapering was on the horizon, or if quantitative easing there, certainly through the Bank of England and the ECB, was going to continue at pace.
Yeah, I think that's a really good question. I think that you have to look at the economies, the US and Europe. And Europe is in a very different place than the US. Europe growth is still very slow, and there's a lot of restructuring that still needs to be done within the European economy. And a lot of the imbalances that we've had in the European economy have taken over a decade to build up. So it's going to take more than a couple of years for this to be corrected. And I think in that environment, rates will stay low in Europe, in the UK, as well as in the Eurozone, in the short end. And I think that overall that means that there are still opportunities within those markets to make money in fixed income, specifically in the Eurozone. We do think that there's opportunities in the Italian bonds and the periphery. Many of these countries have gone through the restructuring that needs to be done and have made good headway. And so therefore their yield, they should be rewarded for that, and their yield should kind of collapse down to close to where Germany trades.
David, you say it's not great, it's not terrible, it's moving along, it's reforming, there are opportunities, but you say there are structural issues. What are they, and how long are they going to take to fix, assuming that there's a will to fix them?
Yeah, I mean, there's a couple of imbalances that have built up over the last decade, effectively. One is labor costs. Labor costs within Germany have been relatively flat over the last decade, whereas in some of the peripheral countries, these have gone up quite significantly over the last decade, and it really means they're not quite as cost competitive when it comes to manufacturing. And so I think on that front, you need to see a bit of a reduction in either the wages in the periphery and or probably wages going up a little bit in Germany to kind of close that gap and allow them to rebuild their competitive advantage within Europe. Because given it's a fixed exchange rate, the only way to do that is to have adjustments to inflation and or wages. And I think that's one of the major issues that we have to deal with that will take time, and it will take several more years for that to kind of iron its way out.
David, we're quite interested to hear about why you like particularly Italy. You mentioned that they do still have a high debt to GDP ratio, and we've obviously been aware of the troubles been facing the ex-president Berlusconi. So I wanted to, if you could just fill us in with some of the changes that you're seeing there, and why you're quite happy to invest in some of the debt in Italian government bonds, for instance.
Well, Italian debt, they've had high debt for over a couple decades, over 100% of GDP, and really the trade-off for that has been that they've had low growth, and that is just the way it is. They've been able to make some changes to the structural issues in the economy, more with making changes in labor laws and areas like that, which will flow through and eventually change the economy. But the main factor is that they run a surplus in their fiscal accounts and a primary surplus, and I think that's really important because that means they're not spending more than they're bringing in, and they can manage to maintain that debt load quite easily. And so I think as long as they can continue to borrow at reasonable rates, then they will actually do quite well, and we'll get through this.
David, we just wanted to get a perspective. Obviously, you look across Europe and the bigger economies, Spain, Portugal, the so-called pigs, as they call them, have dominated headlines. But in terms of some of the other countries that make up the European Union, especially on the fringes on the eastern side of Europe, just give us a perspective on the state of finances in some of those governments on that side of things, and whether they've found their way into some of the Franklin Templeton portfolios?
Well, I do think that in many of the countries on the edge of the Eurozone, several of them still want to get Eurozone membership. They have, one in particular comes out, Poland. I mean, they have a much lower debt to GDP. They're under 65%. That's in their constitution that it can't go up. They haven't actually experienced a recession even back in 08, 09 region. And so they have reasonably strong growth. It's slowed a bit recently, but it is still doing quite well. And I think that they have the will to continue to make reforms and bring their deficits down and keep their debt under control. So if you look at the other ones along the periphery, not to name individual countries, but many of them actually meet the Maastricht criteria that you're supposed to meet in the Eurozone much better than countries that are actually in the Euro already.
Looking at the emerging markets, David, how would what you've said, you've talked about the periphery, and sometimes one feels that some of those countries would be reclassified as emerging markets, and I think it happened recently to Greece. How would what you've said apply to emerging markets broadly, which the comment has been that their growth prospects are not good at the moment?
Well, I want to really focus on Europe today, and I think the Eastern European emerging markets, if you will, actually still have good growth prospects, much better than core Europe. I think that the underlying fundamentals will continue to do well, and I think that you will have much stronger growth than in core Europe. And I think that you can kind of draw that out to most of emerging markets, that they will grow faster than the developed world, and even if it is slightly slower than where they are now, they still have good growth prospects.
David, I just wanted to also get a sense of, we mentioned some of the major economies, and across Europe, from the UK, there's been different takes on what austerity means and how harshly, I guess you could call it, they've been implemented. Have you got any ideas as to which economies of the major European nations you expect to emerge the quickest from the current lull that they find themselves in?
Well, I think it's difficult. I think that the UK has a unique advantage that it has its own currency, and that has had a bit of an adjustment versus the euro, which is its major trading partner. And so I do think that has helped overall the economy. There is austerity going on in the UK. It is maybe not as fast as some people would like. It's probably faster than others would like. But I think there's a middle ground that they can deal with, and that is seen as a good sign. And I think within Europe, places like Germany actually is still growing, reasonably well. I mean, it's going to grow at between 0.5% and 1% this year, and I think that's it's not really fast growth compared to emerging markets, but compared to what Germany's potential growth is, that's actually reasonable. And I think the other one that people focus on is France. I mean, it's obviously the other large economy. It's not doing quite so well. It'll probably have flat to maybe slightly negative growth, but effectively it's just going sideways. But again, France is another country where there are structural reforms that are needed with with the government, and that needs to be done over time. It can't be done immediately. We would all like for things to be fixed immediately, but it really is a long process over the next 5 to 10 years to fix.
Just with specific reference to the Templeton Euro Government Bond Fund, I just wanted to understand how you've positioned that portfolio in particular around the duration of some of the instruments that you've been investing in. Obviously, we've been aware of the risk of long-dated government bonds moving down, obviously more aggressively than some of the shorter-dated instruments. So I just want to get your perspective on duration and how you are handling the potential risk, obviously, when interest rates do start to rise.
Well, I think that as I said, I don't think European rates are going to be rising dramatically in the near future. I mean, if the U.S. rates continue to rise, then Europe will rise in sympathy. But I think the fundamentals in Europe are showing us that actually rates are probably about where they should be now after this recent sell-off. And so we are slightly short duration in this portfolio, about a year short. But we do have some longer dated bonds, like we have some Italy is longer dated, and really looking at those bonds and those those positions that aren't necessarily directly interest rate risk, looking to see what countries will not move as much with the Bund or Germany, and that we'll see that compression of spreads. And that's really what we want to focus on. And that's why you can see our largest holding is actually Italian government bonds, because we really do believe in that positioning.